Smith, and of course it's moderated by our very own Nick Ayton. Please welcome them to the stage.
So, good afternoon. We're going to talk about money, really, I guess, in terms of how do you get hold of it and where does it come from. We've got a very interesting panel here. We've got a good mix of capital markets expertise. We've actually got a family office here for real, so you can actually understand their view of the world. But what I'd like to do is just set the tone here a little bit. We've got a number of questions we're going to cover. Now, you know, private capital is available and it's ready and willing to look at our industry. It's ready and willing to explore new technologies, and it is looking for opportunities to get involved. But it's essentially looking for value as well. So we want to get into the middle of this. So I'm going to ask my fellow panelists here to give a quick introduction to themselves and also maybe touch on what they do in terms of the crypto space. So Steve, kick off.
Sure. Thank you, Nick. Thank you, everybody. And so Stephen Kelso, I run Galaxy Digital here in Europe. We are a crypto investment bank set up by a leading light of traditional financial services, Mike Novogratz. We do four things. We do advisory, principal investments, we do trading, and we do asset management. So all of those exclusively to institutional investors. So if you want to trade your cryptocurrencies, if you want to invest in our asset management fund from an institutional perspective, please get in touch. Similarly, we have made a large number of investments into the venture space, exclusively blockchain, over the last 18 months. Thank you.
So my name is Ray Hindi. I'm the CEO of Belgrade Capital, which is a Zurich-based family office. So I manage the pool of capital of the Swiss entrepreneur in financial services with background in alternative investments. So we run a diversified portfolio, getting involved in a number of strategies. Our favorite approaches are in liquidity provision, generally such as distressed or stressed situations, and technology. So we've been investing in fintech for the last 4 or 5 years and started looking at crypto 3 years ago. The bulk of our investments so far have been in services, so brokerage, custody solutions, and asset management, so equity investment and a little bit of tokens and a little bit of crypto. Starting this month, we're starting to redeploy, but we're going to be doing by selecting the best funds globally, and I can explain why later.
Cool. Alex?
I'm a lawyer, yet another one, but I'm largely a technology lawyer. I've been around the encryption, asymmetric encryption, distributed ledger, blockchain environment probably a lot longer than it's existed in the crypto world. So I sit between largely investors and companies which are looking for money. I look at a lot of business plans, business processes, what blockchain-enabled businesses are doing, and structure deals between family offices and other investors and those businesses. And sometimes that relates to tokens, but I have to say more often, I echo what my colleague just said, a lot of it is investing in the underlying business that's issuing the token, not the tokens themselves.
So we've just come off the back of, I guess, a mad 2017, really fueled by, I guess as Johnny said, greed and fear, but also on the back of huge profits made in altcoins, which fed an ICO market, which was bound to be a bubble and bound to explode. So we're now going into the next evolution as 2018 unravels. We talk about asset-backed securities. How important do you guys think that the language, in order to attract private capital and get more traditional investors, how important is it to use the right language, Steve?
So it's very important. If you look at the biggest investment paradigm theme for the last 10 years since the crisis has been multi-asset investing. That's where the biggest pools of capital have entered capital markets. And what happened there was after the GFC, the Great Financial Crisis, interest rates went to zero because of the monetary policies. So asset managers had to move down the risk spectrum out of bonds, which were the safe staple hitherto, into equities and other asset classes. And that worked very, very well, and has worked very, very well. But now, with real interest rates going up, it is simply an inevitable fact that volatility and the recent spike in volatility that we're seeing at the minute in traditional markets, we have to expect both the frequency and the amplitude of those volatility events to increase. So that leads investors to say, okay, well, is crypto or digital assets appropriate for us? And it very much depends on how you define them. So the two schools of thought amongst those multi-asset investors who are still sitting at the sidelines but very much trying to make their decision, they are faced with the definition of an asset class. So if you look at volatility, if you look at crypto as an asset class, then very quickly it becomes investable for VC funds generally, because a lot of the big VC funds will look at this and they will look at the blockchain companies and the equity that you mentioned there, Nick, and they'll say, okay, there are characteristics there, and it does take the right boxes, frankly, inclusion there. Whereas if you look at the hedge fund space, multi-asset funds and so on, you look at that space and they will rather position it and see it as a strategy, as an investment strategy. And the most sophisticated of the multi-asset funds, frankly the ones that have developed the most impressive track record, are those belonging to the US university endowment funds. None more so, I would argue, than David Swenson's Yale endowment. And they were very much a pioneer of institutional multi-asset investing and the CAPM model and so on. So they have led MIT, they have led Dartmouth College, and quite a few of the leading luminaries in those US endowments, the most technically advanced, the most impressive track records in multi-asset investing into crypto in just the last few weeks. And I think that is, when investment managers realize actually what is appropriate for their customers, what is appropriate for their clients, and any institutional asset manager worth its salt starts from that point of view. And I think that is where crypto is going to sort of find a rapidly growing place in portfolios.
So playing it slightly different way, Ray, because I think what Steve is saying is it appeals to the people with some awareness of capital markets behaviours, but we also have a lot of people in this room maybe that will try to raise money for their projects. So if somebody comes to you and say, will you invest in my crypto? What springs to mind? Volatility, risk, what language do you respond to?
So the way I look at it, and I think I'm going to echo what Steve said because it makes a lot of sense. So there's two blocks. The way I think about crypto or digital assets, or whatever you want to call it, there's two main strategies and two major pools of talent. Pool of talent number one are we're going to call them the Silicon Valley, the computer scientists, the VC guys. And, if those guys invest in the technology, so there's one pool that's the technology play. So is it risky? Is it volatile? Of course, it's an early stage venture investment. That's how I look at it, because I'm investing in the technology. Now, what Steve was talking about, which is really important as well, is the hedge fund strategy, because this is venture that becomes liquid pretty quickly and needs a capital market, a secondary market to trade. And those strategies are very different. It's not a venture strategy, it's a hedge fund strategy. So I was just meeting now with a very successful high-frequency trader in FX. It's moving into crypto. And those liquidity providers earn a premium by being active there. So if a project comes to me and it's a tech project, well, it's within my venture bucket. And what I need to do is build a portfolio of, similar to an early stage portfolio of 20, 30 names, to be able to perform from a portfolio perspective.
Okay. So Alex, I mean, in your profession, you're advising a lot of founders and what have you. I mean, do you find yourself having to repackage the project quite a lot to actually make them appeal to the right communities?
All the time.
And talk us through, typically what you have to do to these projects.
The first thing that usually happens is we'll sit down, and it could be on either side, but we'll sit down with the company or the startup or whatever it is, and you'll get a lot of talk about the product and the behaviour. Usually there's very little basis for the behaviour. I'm going to issue this token and people will do this. Well, why do you know they'll do this? So the first thing that usually gets unwrapped is the business model. The second thing that will get unwrapped is how you get value out of the system. Is this a token play or is this a technology play? Excuse me, I was just thinking. That always happens when you get on stage, doesn't it? It's better. So very often what we'll have to do is how do you want my client, if I'm a family acting for a family office, leaving aside what I call the portfolio investment, I mean the specific venture investment by a family, what is it my client's going to get out of this? Is it revenue? Is it capital? Because as you rightly say, if I'm just buying a gamble, they're going to move on. Most of my family clients they're family money. They're not. If they're backed by entrepreneurs, they'll take an interest in something which is creative. But it's usually revenue or capital, and there's two words that have been coming out in terms of business model. One I've heard today, which is disintermediation, and the other one in blockchain space is dematerialization, is where you simply spread the market and where you can attack the market in a different way because you can distribute the payment structures. And that creates different cash flow models, and those are, we're starting to see them come through. And 2 years ago I was saying, look, actually guys, you don't have to worry about regulation. If you want to sell a token which has an interest in the business, you can sell it to a high net worth individual. So we're asking, well, why can't you attach some rights to your token? Or why can't you have a multifunctional token? Or why can't you have a split token? Or all those things. So yeah, very much it's taking the wow out of I've got a great idea, and to bringing it right back to an investment in something that people can understand.
So it's very traditional, isn't it? I mean, the way that we advise our projects is very much a case of, the opportunity has to be clear, but the investor wants to know, what's the yield, what's the return, what's the risk, and what's the value? In other words, can you have a comparator to say why you think the company is worth so much? And of course, the exit. Now, up until now, investing in the crypto world, exit's been difficult, isn't it, Steve? You can get in, but can you get out?
Absolutely. Liquidity is everything. Sort of the big financial shocks in the system have been, very much a function of liquidity has caused the damage rather than the price action. We saw that obviously during the great financial crisis. We saw that even in a much smaller extent after 9/11, and actually it was when the S&P market shut for 5 days that caught most of the sort of sophisticated European investors off guard, because the natural hedge they had to ensure the S&P didn't work. In the state of the markets now, liquidity is absolutely everything. But what crypto does bring is, of course, it is a volatile investment. It does bring enough potency. It's a high octane enough investment that you don't need leverage within most portfolios for it to meaningfully move the needle. So the first tenet of any wealth management strategy, of any asset manager strategy, the high net worth individual, the family office, protect and grow. Clearly now there is increased focus on volatility given the changing dynamics of the macroeconomic background. I think crypto actually is incredibly relevant now in small measures. So the big discussion increasingly shifting from do we invest in crypto to what percentage, and it is universally going to be a small percentage of the portfolio as to what's appropriate. But as I said, I think most of us in this room can learn a lot from the most experienced investors in the field.
Yeah, makes sense. And Ray, from a family office and investment point of view, what's a big no-no? You know, what's the things that turn you off these projects the quickest? You know, what are the red flags that you see quickly?
I mean, I have to say that, just to be completely transparent here, I'm a family office, right? And today the high quality project, and I'm talking, by the way, I'm talking about, because I'm more focused on public blockchain, right? Today the private projects and the super high quality private projects, they don't come to me. Because to be fair, as a family office, I'm not a brand name in crypto. Let's be clear. And those high quality projects are capacity constrained, and even the biggest names in crypto, which are maybe 6 or 7 in the world, end up having a small position. So all I'm saying is that there are deals out there that are really sought after and are expensive in private markets, and that's what I'd like to have exposure to. I cannot grow directly. Therefore, I need to tap into that symmetry of information, of talent, and sourcing access through specialists.
Yeah.
So all I'm saying is that if there's a project that comes to me that is out of Switzerland, well, already there's a problem. If it's a Swiss project, okay, they're coming to me because they know me in Switzerland, but out of Switzerland, there's a big problem. In terms of, because we're active in fintech, well, does it have to be, I'm passionate about the decentralized nature of protocols. Not, if you bring fintech and put blockchain around it, it really has to make sense. If it doesn't make sense.
So why blockchain, why a token, why decentralization? Because quite often you don't need any of those things. You can,
Absolutely.
So Alex, from your point of view then, is that certainly my experience of investors is twofold. The first thing is institutional capital is sitting on the sidelines waiting to come in, but they don't want their clean fiat money dirtied with dirty crypto money. So that's one thing. The second thing is the family offices that we have built relationships with, a bit like Ray, is we know the parameters in which where their hotspots are and what they want to get involved in. But I want to get your thoughts on this. A lot of the private wealth are saying is, as I said, Steve, the first question was, is the ability to get out. Tell me what you think about this new wave of infrastructure, crypto exchanges, security token exchanges. How important is that going to be to the whole investment scheme?
I think it's been coming right from the outset, and I even have a slight objection to the word utility token. We get asked for opinions all the time on whether things are securities or whether they're utilities. The wrong question. The question is, given what you're trying to do with this particular business and this token, does it attract regulation? And the real fact is that partly opinion and partly fact, is that until you can link the token to a dividend, a cash flow, an ownership, or any of the things which turn into what we now ubiquitously call a security token, it will have limited value. And it'll have limited liquidity and limited value. Now, if you start opening up and thinking of it, you have a lot of blockchain solutions at the moment in trading systems. And we've seen them in everything from bills of lading, digitized bills of lading, obvious application for a blockchain. completely end-to-end. You put a bill of lading in one end, ship arrives at the other end, bill of lading comes out the other end, no intermediaries, disintermediation. Anyone who's running those sorts of businesses are attractive. But the moment you get into, we saw this explosion in ICOs, we've seen the crash. That I've been saying for 2 years, until you get crypto exchanges that can trade what amounts of a security token, it's always going to be limited. And we're seeing that developing really fast on platforms.
But the exit ramps are coming, right? So there's 20, 30, 40 exchanges, all in stealth mode, they're all starting to break ranks. So, lots of people are now saying that the tokenization of the world is the next big thing. The exchanges are therefore the new crypto capital markets infrastructure, and that this is going to end up as a multi-trillion-dollar industry. Is that realistic, Steve? Are they getting carried away, or is there a lot of truth in what they're saying?
For sure, there's a lot of truth in the qualitative claims. Clearly, this is providing access to a lot of assets and asset classes that are too fractional for the traditional capital market structure to support. How long is that piece of string? Again, I think you have to start off from the real world concept. What is the demand for that asset? What is the demand for a luxury item? What is the demand for a billionth slice of a Monet or whatever it is? But it is undoubtedly a very powerful dynamic, and clearly that is going to happen. What I personally think is that actually one of the biggest opportunities in blockchain, and it really points to what Roger Vere's presentation was all about earlier on, the economic freedom, where so many people of our generation have lived under the very real threat of waking up one morning and, for whatever reason, the authorities have reduced the net wealth of that individual, and through, call it tokenization, call it securitization, call it access, a lot of, hundreds of millions of people have potential for security of their wealth through tokenized access.
It makes sense, doesn't it? Because, traditionally speaking, if you want to offer a security, generally speaking, you have to be a regulator or a listed business to be able to offer your shares to the public. The way that we think about tokenization is that, in a sense, it has the potential to make an interest in the business more fungible. So you can issue some tokens which are directly linked to the performance of the business, and then you can buy the primary issue, so you can lock in some value. But the limiting factor until these exchanges appear is, how do you trade in the session if you want to? In terms of risk weighting, the ability to get out, Ray, is near number 1 or 2, is it for you, in terms of, if you need to get out, you want to get out?
Absolutely. And that's why the infrastructure is very important, and that's why if the market flourishes, all those activities, those market makers are important as well, right? Because you need balance sheets to market make all of that, right? So
And the big mistake that often entrepreneurs make when they come to us or ask for help is they think they're going to issue this token, there are going to be loads of buyers, and then the secondary market will just flourish day one. They don't understand the fundamentals of liquidity, So, Alec, does that annoy you? Because it annoys the hell out of me, because it's obvious.
It sort of does. I'm going to do something really odd now. I'm going to talk a bit about history, because this whole thing got me really interested. And I went back and thought about tokens as private money. And I thought, well, we had private money before. If I bore you all, just throw buns or something.
I'll stop you if you get
Yeah, do that. That's good. But actually, private money came out in the 16th century in Venice with the Medicis. Medicis, if you wanted to ship a ton of silk from China, you went to Medicis, and Medicis would issue a bond, and people would accept that bond for the value. And then you look at the UK, why did we have the NatWest Bank and the Midland Bank? Because we had 27 different currencies. And every bank issued a note. And why did you accept the note? Because if you went back to the bank, it would ostensibly give you gold, or somebody else would give you something for it. And it's almost, I think it's almost inevitable that cryptocurrency will mature. And I sort of asked myself the question, well, how do you get in and out of that market? Who's going to be the next Medici? This one is going to get bonds thrown at me. The obvious players, the big traders, the Amazons. Amazon can issue a token tomorrow and redeem it. And the moment it's redeemable, it's tradable.
Agreed.
So, you know, maybe take a big step back. This is going to have, in my view, I don't like futurizing because, you know, you're hostage to fortune. But it's going to happen. Tokenized, decentralized exchanges of value is going to happen. It's just going through that growth. And somebody's going to crack this. Is it going to be Bitcoin? I don't think so. Is it going to be Ripple? I don't think so. I think it's going to be an Amazon. And I think once you crack that, then all that infrastructure will grow around it. All the trading, the Medici, what I call the Medici phenomenon. But it's got to come from trading. You can't just wake up one morning and say, I'm going to invent a pound note. It doesn't work like that.
So that's a very positive note, I think, to sort of end. We've got time for one question. Alex, I don't think so. So brilliant. I think what I would say is that there's a lot of learnings to be made around how to get access to private capital. If you are founders with projects, it is important to think about the language, how you package things up, understanding what's important for the investors. So on that note, thanks very much, panel. Been great to talk to you.
Thank you very much. Thank you, Nick.